That's exactly right. So, I mean, look, I think I guess 6 months ago, we were very focused on the Fed. I think the bond market, some of the bond investors were focused on, the Fed. The Fed was behind the curve. It was kind of obvious they were going to shift coming out of that August Jackson Hole meeting. So we call that the fire part of our narrative. And I think equity investors just didn't think it would matter. But of course, it did matter, and it mattered gravely for the very expensive parts of the market. And that now has adjusted, and that's good. That's part of our call for this year, is that the derating process was going to be most severe for that, most expensive part. I still think the derating process is incomplete. The question now, though, is can earnings growth, revisions, as Jim puts it, can that offset another 10% plus derating at the S&P level? And our view is that, we don't think that's going to be the case. We think now we shift our focus towards the slowdown that was already in place, and the Fed now is tightening more than even we expected going into that. And that should lead to further deceleration. So there won't be enough revisions to offset that derating. So that's where we are. We're just kind of stuck. It's not the end of the world, but we got to get through that. And I think the risk on those earnings revisions is the greatest in the first half of this year, first quarter, second quarter, because that's when the pent-up demand is fading the most. The comparisons are most difficult. And we're starting to see some supply pick up now in areas which could actually lead to some deflationary whiffs of deflation in certain areas where there's going to be pricing power, right? Where there was not enough discounting over last year, and that all has to play out. So it's going to be messy for the next, I would say, 4 to 6 months.
How do you invest in that sort of environment? And I'm thinking about the idea, the notion that there's not going to be much growth. And the playbook of investors in the past has been to go to technology when there isn't cyclical growth in the economy. But that is the precise sector that is getting derated, if you will, in this volatility.
It's exactly the right question, Melissa. I mean, normally I would say go right back to the FANGs, go right back to the secular growth. The problem is a lot of the secular growth stocks, never experienced the recession because there was a pull forward in demand. So that's the difference this time. That's why we're seeing some of these fallen angels in the forward favor group. And I think that's the way you got to look at it. We're looking at, we call this the year of the stock picker, because even within groups, there are going to be stocks that don't make it because they can't execute, and there are going to be ones that do execute and make it. And so it's really about stock picking, and that's what it's going to come down to. So this idea that it's tech versus banks or energy, I think that's out the door. I don't even like the value versus growth so much. It's what stocks do I want to own within each sector? And it's going to come down to who can execute in a very difficult operating environment, deliver the revenue growth either through unit growth or pricing power, and hold on to that margin. So that's the game. It's just getting hard. It's been harder. We're in a bear market for stocks. We've been in one for 6 months. Anybody can see it. The index is held up. Our view is that the index will eventually catch down. That could be wrong. That's our view. We'll see how it plays out. Right now, we're just trying to pick stocks within groups.
Weiss, you got a question?
Yeah, actually, my question was just that. You take a lot of let's say, guff for your market view, which has been pretty consistent and actually pretty right when you get past the indexes. So I'm sure you have these numbers. If not, just give us an estimate. What is the average S&P stock down over the last year with the market being essentially flat?
Yeah, I mean, obviously stocks have corrected at different times, Steve, as you know. They don't all correct at the same time. But
right.
we have, let me give you a really interesting statistic. We've quoted this many times. 50% of the NASDAQ, was down 50% or more at some point in the last 6 months. I mean, that's an incredible statistic, I mean, that's like a Cat 5 hurricane out there. So that's what investors are dealing with. They're trying to navigate this storm. That's what we do for a living. We had a year and a half of kind of a gravy train, over earning, multiples are going up at the same time, and now we just have some headwinds. And we'll get through this. We're not calling for recession. We don't think it's the end of the world, but it's going to be more painful, I think, for the index now than it is going to be for the average stock. And that's what some of those FANG stocks breaking down may be telling us, One thing that, we look at a lot is technicals when you get to this point. And I'm not a technician, but I do look at things. I think very simplistically, you can say that the NASDAQ and the Russell 2000 are clearly broken on a simple 200-day moving average. The S&P is kind of holding on. We think ultimately it will cave. We'll go down and retest the lows in January. At that point, things look a lot more interesting. Closer to 4,000 on the S&P is a point where we'd probably get more bullish on the index.
Anastasia, you got a question?
Yeah, I got a quick one for you, Mike. I mean, your view is somewhat against consensus because a lot of strategists are calling for a cyclical reacceleration and cyclicals to do well as the yields go up. So would you at this point recommend that investors pare back some of their cyclical exposure and their value exposure and go to some of those pockets of tech that nobody wants to touch because the Fed is hiking rates?
Exactly right. Thanks for that question. I mean, 'cause that's basically our view now is that, we've been very sort of bearish on the very high multiple stuff, and now we've shifted that view in the last month or so to say, hey, be careful with this really cyclical stuff that needs economic growth. If you think growth is going to slow, as we do, some of these areas actually probably gotten ahead of themselves, right? With falling PMIs and consumer confidence already in recessionary levels, some of these lower quality cyclical parts of the market actually look more vulnerable now than say these, high multiple growth stocks. The sweet spot for us is really defensively oriented quality, okay? And that actually is boring. It's not exciting. It's things that have dividends. They pay dividends. They're growing those dividends potentially. They're bond proxies, so to speak, because the bond market's been in a bit of turmoil. I would say the one thing that could change our view would be, let's say the back end stops going up. We're already in a flattener environment. If that were to happen, okay, then you may see a full-on defensive bid for things like utilities and some of the stuff that the market hasn't been willing to go to, because right now the market still thinks that growth is good enough. And that's going to be the $64,000 question. We'll see how it plays out.
Well, you put up your base case, Mike, of 4,400, which is about 50 S&P points below where we are right now. And I'm wondering if part of that base case scenario is inflation comes down, but it remains persistently high. That the Fed can't get a handle on it, that it's a little bit behind the curve. And so the impact of a Fed rate hike is going to take much longer.
Yeah, I mean, look, I think it's, once again, I think it's going to be really messy. I mean, first of all, I think the chance of inflation getting, significantly below 4% is going to be a challenge, okay, even with the Fed doing all of the hiking that now is priced into the market, which I'm skeptical that they can actually get all that done, but they're going to try, okay? But, so inflation is going to remain higher than normal, which is going to put pressure on multiples. But once again, it's going to come down to who's right about growth. I think, Jim is saying he thinks growth's going to accelerate. It's going to be great. And if he's right, stocks are going to be fine when 4,400 is going to be too conservative. If we're right, then we're probably going to overshoot to the downside first, and we're going to be clawing our way back towards 4,400 as, growth resumes in the second half of the year.
Mike, always great to speak with you. Thanks for your time.
Thank you.
Mike Wilson of Morgan Stanley.